Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 27th of January. I'm Daniel Lam, your host for the podcast. There were some really sharp moves in the Japan currency and bond markets. Last Friday, Japan Prime Minister Takaichi vowed to fight against speculation of the yen. The weakening yen has pushed up import costs and broader inflation, hurting households' purchasing power. Now, the Bank of Japan is also focused upon inflation. In its meeting last Friday, the BOJ held its policy rate at 0.75%, but it delivered a hawkish signal by revising its growth and inflation forecast higher, and stated that it will continue to raise rates if those forecasts materialize. And the BOJ may already be behind the curve. Now, Japan has exited its decades-long deflationary period and liquidity trap, and the multi-year path for yields is higher. Its labor market is tight, it's got decent growth momentum, inflation is above target, and there is accelerating trend in price pressure. To tackle inflation, Takaichi has compiled a big spending package to cushion the blow from rising living costs and vowed to suspend for 2 years the 8% sales tax on food. But this will increase the already high Japan public debt, and we saw the recent spike in bond yields in the JGB. Now, after the jawboning from Takaichi, the dollar yen has come off sharply from very close to the 160 psychologically important level. But that does not eliminate the concerns regarding how to fund this spending, even though the Prime Minister has stressed that Japan can secure enough funds for the tax suspension without issuing debt. Now, while most parties in the upcoming snap election are calling for a cut in the consumption tax, several opposition parties have proposed investing the BOJ's holdings of exchange-traded funds and government reserves set aside for currency intervention to use the proceeds to fund the consumption tax cut. But these are not without issues. So, for example, using the reserves set aside for currency intervention would require selling US treasuries, and that can affect markets and cause issues. Tapping the Bank of Japan's assets risks undermining the central bank's independence, and that could be a dangerous step that could further weaken the yen and push up longer-term interest rates. We believe that ultimately inflation is likely to be stickier in Japan, and investors will be focused upon the tightening BOJ versus the easing Fed. That would lead to medium-term pressure on the dollar yen, leading to strengthening of the yen. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.